While investment banks pay Ivy League graduates $150,000 a year to build complex financial models, a tiny, ultra-optimized Chinese algorithm is doing the exact same work for pennies on the dollar.
Imagine a young analyst, fresh out of Wharton or Harvard, sitting in a glass-walled skyscraper in Manhattan. It is 3 a.m. They have had 4 cups of coffee, and their eyes are bloodshot as they manually copy and paste revenue numbers from an SEC filing into an Excel sheet. This is the grueling grunt work of high finance, a rite of passage costing Wall Street institutions millions of dollars annually in salaries.
But across the Pacific, a parallel reality has emerged. In Shenzhen, a team of software engineers, utilizing Microsoft Research Asia's open-source Qlib framework, released a highly compressed, localized quantitative model. Running on hardware that costs less than a decent wristwatch, this tiny software agent did not just automate data entry. It mastered the art of valuation, cash flow forecasting, and dynamic risk analysis in real time.
To understand how a $10 algorithm can outsmart a $150,000 human brain, we have to look inside the engine of financial modeling. Think of a financial model like a highly complex mechanical clock. Every gear represents a variable: interest rates, seasonal consumer demand, capital expenditures, and supply chain bottlenecks. If one gear slips, the entire clock breaks.
A human analyst builds this clock tooth by tooth, manual cell by manual cell, over several days. The algorithm, however, uses layout-aware retrieval-augmented generation combined with graph neural networks. Picture an army of microscopic, hyper-fast speed readers. The instant a company publishes its hundreds of pages of unstructured earnings reports, these digital speed readers scan the text, extract every crucial variable, cross-reference them with historical industry data, and instantly construct a flawless 3-dimensional model of the company's financial health. According to recent industry benchmarks, these lightweight models can parse and evaluate a complex 10K filing in less than 4 seconds. A human analyst takes, on average, 4 to 6 hours to achieve the same depth of analysis, with a 5% margin of error. The AI's error rate? Less than 0.5%. But the real disruption is not just about speed. It is about the sheer collapse of operational costs. In early 2024, a boutique hedge fund tested this localized, highly optimized model against a team of newly hired junior analysts. The human team cost the firm roughly $75,000 for a month of comprehensive research and modeling. The AI model, running on a decentralized cloud instance, executed the exact same workload with higher predictive accuracy for exactly $9.42. This has triggered an immediate, quiet panic inside the world's most prestigious investment firms. For decades, Wall Street's moat was its ability to monopolize elite talent. By buying up the brightest minds, banks controlled the proprietary knowledge of the market. But when an open-source tool allows a college student in their bedroom to run institutional-grade risk models, that moat evaporates overnight. This leaves the future of finance at a critical crossroads. The value is no longer in building the spreadsheet. The value is in interpreting the anomalies the machine uncovers. The era of the high-priced spreadsheet warrior is officially dead, replaced by an elegant line of code that costs less than a cup of coffee.